Good day, my name is Ralph Thomas and I'm the co-portfolio manager of the balanced funds across Sanlam. Today I'd like to talk about global property, and property in general is a lot of it is influenced by our thinking in the South African context. But global property is a very, very different asset class to local property. For example, if you have a look at our local property market, the top 3 shares basically dominate their entire exposure. 50% of the index is made up of the top 3 shares. So we've got about 22 odd companies that we can invest in across 4 subsectors in South Africa. In contrast, if you had to look at global property, you're looking at something like 355 companies across 17 subsectors. But the important thing to note here is it gives us the ability to be very, very strategic and almost surgical in terms of the kind of exposures that we seek to take. So for global property, and we invested in the balanced funds in global property a few months back when there were a lot of questions why. Well, this is the reason why. We invested in things like data centers, which have done really, really well through both the COVID period, but also post-COVID, we expect data centers to do quite well. Things like healthcare that we don't have access to in South Africa. So we've got access to a highly specialized, very deep, very wide market in terms of diversification to be able to pick certain stocks that we feel would best suit our investment intentions. You then look at the nature of global property and the kind of forces that are behind it. And the chart that I've shown here is building starts. So basically this is supply into the property market. And you can see since the GFC that number has been fairly constrained, and the growth in supply has been well below long-term average. Well, what does that mean? Well, you need to look at the different subsectors to make sense of this. If you look at the residential subsector, you'd want to probably compare this against population growth. Population growth is well in excess of the kind of buildings that are coming online in terms of supply in the residential sector. But then also in terms of offices, you need to also have a look at the nominal GDP growth, which again is well in excess of the supply coming online. So what does this mean? It means that distributions, earnings of these companies will be well protected and actually quite well supported. If we then turn our attention to the prospective returns we can expect from foreign property as an asset class, we've generated a matrix of possible return outcomes given a range of assumptions, working off a forward dividend yield of about 3.6% and a distribution growth of about 6.1%, which again is supported by the low building starts, in other words, the low supply coming online. We see, even with a slight derating in the exit distribution yield of around 4.5%, we expect around 8% for the asset class. And when you adjust for inflation, that is pretty much in line with the long-term trend return that we've seen from foreign property recently. So then, we then have a look at the experience to date that we've had in global property. You see that global properties actually performed really, really well relative to global equities and definitely relative to global bonds. And this has provided a useful diversifier of alpha in our portfolios to date. Going forward, we expect that trend to continue as we seek to diversify even more and become a lot more tactical and strategic in terms of our allocation to various subsectors globally. Thank you.